When I first started trading Forex, I swear there were so many different strategies out there, and I was jumping from one to the next, just trying to find that one perfect strategy. But after a year of trying everything, I stuck to just one. And I mean, it's made me close to 6 figures in this past year. And you know what I found out? Most of those other strategies were just overcomplicated bullshit. And I've now connected to loads of profitable traders from around the world, and guess what? They all just trade the same simple, proven strategies. And that's what I'm going to show you today. So here's my simple 5-minute supply and demand strategy. And honestly, not a lot of people know about it. But here's the big question. What makes it different? Well, as a supply and demand trader, I'm pretty much just going to be trying to get in where the big players are. I'm talking about those guys moving hundreds of millions, if not billions of dollars. And if I can figure out where they're entering and exiting, then I'm just going to be right there with them. So firstly, I'm going to show you a more normal approach to supply and demand. And then I'm going to show you my revised and improved approach that's made me close to 6 figures trading gold, GJ, and a bunch of other pairs. So in order to mark out our areas of demand, you know, where the big investors are placing their billions of dollars, all we need to do is wait for a large push up, whether that's 2 to 3 large candles or a whole piece of structure. And now we have everything to consider this an area of demand. The reason there's demand to getting down here is because the big institutions and large investors usually just miss this initial move, you know, where we just came up. So when price wants to come down back into this zone, they're going to take that opportunity to get in at this good price, and we're just going to be piggybacking off of them. So once we've found this bullish move, all we're going to need to do is mark out the bearish candle before it. Just this bearish candle at the start of the move. This is going to give us a strict set of rules that we can follow from trade to trade, rather than just spitballing guesses at the start of each setup. Very simple stuff. We now have our demand zone. Now, here's where my edge comes in. Whilst most retail traders are just waiting for price to come back to these basic zones, completely relying on investors just jumping in here, this is where I start to take things up a notch to improve our win rate and risk to reward per trade. So really simple, we're going to wait for price to come back down close to our zone without actually touching it. And then we want price to come up and break the high to the left, just like that. I promise this isn't complicated, and if it seems it, you will get the hang of it really quickly. But why do I want to see this? Haven't we just missed the move already? Well, no. All we've done is made a basic retracement and then shown that we're going to keep continuing it in this bullish trend by breaking this high to the left. And now I've created another demand zone, as well as a solid level of liquidity just before it. Now, I'm sure you've heard of the term liquidity before, even if you're just a beginner. All liquidity really is just trader stop losses. The market likes to manipulate price to take out these stop losses before moving in its intended direction. Liquidity is one of the biggest market drivers, and something that normal supply and demand just completely fails to take into account. You're going to see liquidity grabs everywhere in the market. Price takes out lows or highs by just a couple of pips and then shoots off in the opposite direction. So where does liquidity hide? Where can we expect to see large clumps of stop losses? Like I said before, below lows and above highs. Just like right here. Traders like to put their stop losses below these lows, since if price wants to come down and break these lows anyway, there's a large chance that we're just going to keep continuing in a bearish direction. But where else are stop losses going to be? Well, below these demand zones. Normal supply and demand traders are going to be placing their stop losses under this candle, below the zone, which is literally just going to be adding on to our existing level of liquidity. Now we've filled every requirement for price to want to continue in our direction after it hits our demand zone. We've got a great price for investors, a large level of liquidity, and we've confirmed our direction by breaking this high. There's no need to overcomplicate things when we already know exactly what moves the market. We're not reinventing the wheel, we're just using common knowledge to create a really powerful strategy. Now, let me show you some more examples. Alright, so for our first example, we're literally just going to be going through what we've just talked about. The first step being looking for a large movement in our direction, leaving behind that demand zone. And this is where we want price to come back to. After this, we want that level of liquidity to be formed, so we want price to come close to our zone and then break its own high, just to confirm trend. And as we can see, liquidity is formed just here, and its own high is broken. It's also important to mention that another demand zone is created on this swing, just to once again add to that existing level of liquidity. We're looking for this zone to be invalidated before coming back to ours. For example, gives these normal supply and demand traders an entry and then fakes them out straight away. The final step is literally just waiting for our entry. We'll take it on this first close just here, first close in our direction. And as far as TPs go, I don't see any reason why we can't just target the high. We've already confirmed the bullish direction, so I have no doubt that we're just going to continue going in a bullish trend. Then we just let it run. And as we can see, TP hit. Once again, we're just so confident on direction, and we can clearly see price just loves running even after our TPs are hit. But let's not be greedy. Anyways, let's go on to another example just to try and drill this in. Alright, so now I've looked at a few examples of demands. I thought it would be smart to come onto a different pair to show you that it does work across pairs, as well as showing you a supply example. So, first step, look for movement in our direction. As we can see, there is a supply form just here, which is going to be the bullish candle before the bearish move. Rather than on a demand, it's the bearish candle before a bullish move. We mark out our area, and then as we can see, some level of liquidity is already formed. We want a minimum of 2 candles, since it's enough to make an actual swing. So, let me just mark this liquidity. And then obviously, we want it to be broken. Just like that. And this setup has actually already created another level of liquidity, as well as that zone that we love seeing. Now this extra zone is not always required, but once again, it's just going to be that extra level of confluence that's going to add to the chance of it winning, ultimately giving you a better win rate. And then we wait for its low to be broken. As we can see, it's already been broken. I mean, that's a lot more convincing. Fake outs from this zone. But yeah, once again, to be honest, 2 levels of liquidity, this just wants to be grabbed. This is generally what moves the market. So we wait for it to come back to our zone. Just like so. And our entry is going to be on the first close in our direction. So in this example, it will be the first bearish close, just here. Once again, as far as TPs go, I see no reason to not target these lows. Like I've said before, with confirmed direction, and we can just let it run. Jesus, as you can see, even after hit and take profit, it just loves to go in our direction. And there really is just minimal retracement on a lot of these trades. What you'll commonly see in normal supply and demand is that zone created, demand zone just at the bottom of this move, come back down to the zone, price rejects, you possibly get your 1-to-1, and then it always just goes against you, meaning there isn't much chance to get high risk to rewards. Whereas with liquidity supply and demand, we have that initial push up, price will come close to our zone, also forming another demand. Trend will be guaranteed by breaking the high to the left. We like to see that little rejection from the demand zone that we want to be invalidated. And then price comes back to our zone, we get our entry, and now every requirement has been filled for price to just run in our direction, just leading us to get super high risk to rewards. So now you've seen a good example on a demand and a good example on a supply, showing that it works across pairs. So that's pretty much the base of the strategy. Go back test it for yourself and you'll just see the results. I'd also recommend joining the free Discord in the description below. Meet other like-minded traders in there and really learn the strategy in detail. I'll be posting my own breakdowns of the trades that I actually took, answering some questions and posting exclusive content on there as well. But that's it for this one. Make sure to subscribe. Like if you learned something new in this video, and I'll see you in the next one.